My name is Paul Borosky, and I am the owner of Quality Business Plan, and I am often asked by my clients and potential clients, what goes into my financial statements, how do I do my financial projections, and why are my financial projections better than, competitors or better than just your traditional standard SBA website information. And so what I'm going to do is kind of explain to y'all how I do my financials and why they're so good, from my most humble of opinions. So I've labeled this a financial forecasting, a bedtime story with numbers. And why I call it a bedtime story is that I like to have my financial statements tell a story about, what the company is going to do, where it's going to start, how it's going to grow, and, in the end, where are some benchmarks that the company needs to be financially? And all this stuff can be done, through some good financial projections. And before I do that, y'all get to sit through a 30-second infomercial spiel about me and my company. My name, again, is Paul Borosky, MBA, doctoral candidate, finishing up my doctorate's degree. Website is qualitybusinessplan.com. And I do business plans, business consulting, and also financial forecasting, as well as web design, resume writing, and pretty much I do any kind of writing that a business is going to need, whether it's a standard operation manual to, heck, emails and stuff like that. So I've got quite an extensive resume. And I also have published a couple books. First book is The Complete Small Business Funding Guide, Fundraising to 2019. And then I've also published the R-rated guide to passing your finance class, time, value, money. All right, so with that said, let's dive into how I construct my financials and why they are better than the average bear. So when I do my financials, I'll almost always start, and this example right here is from a restaurant, I'll always start with identifying the main items, main menu items, or if it's pest control, the main services that are going to be sold. And once I do that, then I come up with some averages. What do you think an average day sales are going to be? So I start with my average day sales, and then I'll come up with my percent of sales cost. So if you sell one hamburger, how much of that burger is, you have to pay the supplier for? And then we'll put it into percentages, because everything, when you do your financials, everything is a guessing game. And, if you have a rhyme and reason behind the guessing game, fantastic. If you're just throwing out numbers just to throw out numbers because they look pretty, well, that's not going to hold water with an investor or with a loan officer or an underwriter. This process right here, starting with average daily sales and average, cost for sales, it gives us a structure to build upon. Once I'm done with that, I'll then do my labor. How many employees are you going to have? I'll put the number of employees here. How many managers are you going to have? And then whoever the business owner is, you have to pay yourself. Too many times a business owner comes in and says, look, I'm not going to take any salary for the first year. Well, fantastic. That's your prerogative, but for your financial statements, it better be in there, because no investor and no bank loan officer is going to buy that story that you're not going to take any money out of the company. It's not going to happen. Put it in there, get in front of the problem. So make sure, and that's why I put it in gray right here. This is the salary for the owner, and then the managers underneath, and then the number of employees. And then I'll sum it up right here. And then a startup cost. This is important. Now again, this is not a in-depth breakdown of the startup cost. This is just subsections. For the front of house, what is it going to cost? For your company. For the back of house, how much money are you going to need for that information? So you give yourself some budgets here, and then later on in other tabs, you can break out those and you can itemize the list. And then once you have the itemized list, then you just tie the sum into the structure right here. Office equipment, almost all companies are going to need this. And then make sure you talk about your licenses as well, and then sum up your total startup cost right here. The next segment that I do with my business plans is going to be the monthly fixed cost. I'll fill out my monthly cost right here, whether it's the rent, electric, utilities, legal, advertising, and then I'll sum it up what the monthly costs are going to be. Miscellaneous information, cost of capital, won't worry about that right now, and then your tax rate. What is your tax rate? And again, for the most companies, I put 20%. All right, and so once I get my structure here filled out, and this is my information page, this information page is going to now complete all of my other documents here. I change this information here, everything rolls over. So for example, my profit and loss for the month, these revenues right here are $75,852. Well, that aligns right here, this 75,852, 75,852 for monthly sales. So you see how I've got my average daily sales, and I operate 7 days a week. That rolls into monthly sales right here, which I immediately pull over to my first month here. And then I grow my revenues. I have my sales growth right here. I'm projecting a 3% sales growth per month for the next several months. Well, now my revenues are going to grow off of that as well, and my revenues are going to grow by 3%. If I project my revenues to grow 5%, well, I change this right here, and then now my revenues are going to grow to whatever they want them to be. For the cost of goods right here, well, that's beautiful because I've got my cost of goods right here, 20%. So my 20% is going to hold true right here. So no matter what my revenues are, my cost of goods are going to be 20% of this. And then my monthly salary right here, all my monthly expenses, well, we pull those over from our labor section and our monthly fixed cost section. So that information would go right in here for the expenses. So now we've got our daily sales, summed up for the month. We've got our cost of goods lined up with the percentage. And now we've got our expenses on a monthly basis. Once we do that, we can now figure out what our net income is going to be after we back out the taxes. And so that's how the first month works. And then my growth estimates, that impacts my revenues. Then we use common sizing right here to estimate what the percentage of the salary and rent and utilities are going to be based on sales. And now we can project how much the costs are going to grow. Now, sometimes I'll use a common size for the cost, and sometimes I'm just going to say, you know what, the salary is not going to change no matter how busy you're going to be. And so it really depends on how the business owner wants it structured. However, everybody's a little bit different, but a lot of the fixed costs are going to stay the same, and I project that out. Once I do my 12 months, and I get my 12 months all the way across, and again, using my revenue growth, 3%, I'm able to project all my revenues and then my costs and my labors, etc. I then roll my 1 year profit and loss into my pro forma income statement right here. And so you see how we've got the revenues of 1.07 million here. Well, we go over here and we've got it 1.07 million here. This is summed up. So now everything's aligned and it's rolling into our income statement. And then again, we do the same thing. We project our revenues for the next 5 years. The cost of goods are going to be the same percentage. And then we estimate some growth costs for the expenses. That's how you're going to get a well-aligned income statement based on daily sales. So that alignment for the 5 years starts with the daily sales, monthly labor, monthly fixed cost, goes into the annual, and then we project the annual for the next 5 years. And in order to support all that information, we could throw in some financial ratios. We can show a graph here showing what the revenues are doing, revenues as compared to net income, and we can show how when the revenues are growing, the net income's growing as well. We've got return on equity calculated here, return on assets, current ratios, profit margins, and then we can even get into the capital budgeting and show how much the value of the company is. Based on these cash flows, based on an investment of $480,000 and these cash flows that we've got projected, we can anticipate that this company right now is worth $2.5 billion with an internal rate of return of 75%. So we can take all that information and we can do all kinds of wonderful financial ratio estimates and capital budgeting estimates, and then we can do our break-even analysis, and we can show you, well, if our annual revenues are this and our cost of sales are this, then our gross margin is this, and now we know what sales we need to be able to come up with in order to break even. So all this information can be gained just by having a solid foundation from just one page of information. So hopefully this information was helpful for me to show you why these financial statements that I've created and that I use in my business plans, and also, for financial modeling for my customers as well, why they're so powerful. And if you all need some help with some financial forecasting or financial modeling, please don't hesitate to give me a shout. And again, my website is Quality Business Plan, and my name is Paul Borosky. I look forward to working with you. Thank you.